You're watching the news and suddenly you hear the Dow Jones dropped 400 points today. What does that even mean? If you've ever felt completely lost when people talk about the stock market, you're not alone. Most people see headlines like market crashes and just scroll past, hoping it doesn't affect them. But here's the truth. The stock market affects almost everyone, whether you know it or not. Your retirement, your savings, even the price of everyday products are all connected to it. So what exactly is the stock market and how does it actually work? Don't worry, by the end of this video, it will all make sense. We're going to break it down step by step in the simplest way possible. No complicated jargon, no confusing charts, just clear, simple explanations that anyone can follow. This video is for anyone who has ever wondered, should I invest? Where do I even start? Let's figure this out together. Welcome to the Stock Market Explained Simply. In the next 10 minutes, you'll understand how the stock market works from the very beginning. Let's start with the most basic question of all. What is a stock? Imagine your friend owns a pizza restaurant. The restaurant is doing great, but your friend needs money to open a second location, so they offer to sell you a piece of the business in exchange for cash. That piece is called a stock. When you buy a stock, you receive a stock certificate, essentially proof that you own a small piece of that company. Think of it like a golden ticket that says, this person owns a fraction of this business. Simple as that. Companies of all sizes, from tiny startups to massive corporations, can issue stocks to raise money. The bigger the company, the more shares it has available. One share of a giant company is just a tiny slice of a massive pie. When the company makes money and grows, the value of your share goes up too. So if you bought a share for $10 and the company triples in size, your share might now be worth $30. That's how investors build wealth over time. To summarize the most important concept, a stock equals ownership, and a share is one unit of that ownership. Every time you buy a share, you become a part owner, a real legitimate shareholder of that company. Now that we know what a stock is, where do people actually buy and sell them? That's where the stock market comes in. The stock market is like a giant marketplace, but instead of fruits or furniture, people are trading pieces of companies. The stock market connects three main groups: companies that want to raise money, investors who want to buy ownership, and sellers who want to cash out their shares. These three groups are constantly interacting every single day. Think of it like an auction. Prices rise and fall based on how many people want to buy and how many people want to sell. When demand is high and supply is low, prices go up. When supply is high and demand is low, prices come down. The most famous marketplace for trading stocks is the New York Stock Exchange, or NYSE, located on Wall Street in New York City. It's one of the largest and most well-known financial institutions in the entire world. Here's an easy way to think about the stock market. It's like eBay, but for companies. Buyers and sellers come together, agree on a price, and make deals, but with far more rules, regulations, and transparency than your typical online marketplace. The New York Stock Exchange, or NYSE, is the largest stock exchange in the world by total market value. Billions of dollars worth of stocks are bought and sold here every single day. It's the heartbeat of the American financial system. Another major exchange is the NASDAQ, known for being home to many of the world's biggest technology companies, including Apple, Google, and Amazon. Most of today's trading happens electronically through platforms like these. Beyond the US, there are major stock exchanges all around the world: the Tokyo Stock Exchange in Japan, the London Stock Exchange in the UK, and the Shanghai Stock Exchange in China, to name just a few. The stock market truly is global. So how does a company get listed on a stock exchange in the first place? Through a process called an initial public offering, or IPO. This is the moment a private company opens its doors to public investors for the very first time. During an IPO, the company sets a price for its shares and sells them directly to investors. The money raised goes directly to the company to fund growth, hire employees, build new products, or expand to new markets. This first stage of selling shares directly from a company to investors is called the primary market. Think of it as buying something brand new, straight from the manufacturer. The company gets the cash, and you get the shares. But what happens after that first sale?
The shares can now be bought and sold between investors without the company being involved at all. Investor A sells to Investor B, who later sells to Investor C, and so on. This ongoing buying and selling between investors is called the secondary market, and this is where most of the daily stock market activity actually takes place. The company doesn't make any money from these trades, it's purely between investors. Today, most of this secondary market trading happens through online platforms and brokerages. You can buy and sell shares from your phone or laptop in just a few seconds. The whole process is fast, digital, and accessible to almost anyone. When you go to buy or sell a stock, you'll encounter two key prices: the ask price, the lowest price a seller is willing to accept, and the bid price, the highest price a buyer is willing to pay. The gap between these two is called the spread. For a trade to happen, the buyer and seller need to agree on a price. If you're willing to pay $52 and someone is willing to sell for $52, congratulations, the deal is done. The moment they meet in the middle, the transaction is executed. Every completed trade involves a buyer getting their shares and a seller getting their money. These transactions happen thousands of times every minute on stock exchanges around the world. It's an enormously fast and efficient system. So what makes stock prices go up or down? It all comes down to one fundamental principle: supply and demand. When more people want to buy a stock than sell it, the price goes up, just like a seesaw tipping in one direction. When demand for a stock surges, maybe because the company just launched an incredible product, everyone wants in. More buyers mean more competition for the same limited number of shares, and the price rises quickly. On the flip side, when more people want to sell a stock than buy it, perhaps because of bad news about the company, the price drops. Sellers compete with each other to find buyers, and the price falls until buyers are attracted back. This constant tension between supply and demand is what makes stock prices move every single second of every trading day. No central authority is setting these prices. They emerge naturally from millions of individual decisions. One major driver of demand is company performance. When a company announces profits that are higher than expected, called beating earnings, investors get excited and rush to buy. The stock price typically jumps in response. Bad news has the opposite effect. If an economic slowdown is announced or a company reveals unexpected losses, investor confidence drops and people sell their shares quickly. This is called negative market sentiment. The stock market is deeply emotional. Fear and optimism both drive huge market movements. This is why markets sometimes behave in ways that seem irrational, because human psychology plays a massive role in investment decisions. Now let's talk about who actually participates in the stock market. First, you have investors, individuals and institutions like pension funds and mutual funds who buy shares with the goal of building wealth over time. Then you have traders, people who buy and sell stocks very rapidly, sometimes in seconds, trying to profit from short-term price movements. Traders are laser-focused on charts, timing, and speed rather than long-term company value. Between you and the stock exchange sits the broker, a licensed professional or platform that executes your buy and sell orders on your behalf. Online brokerages like Fidelity, Schwab, or Robinhood play this role for millions of everyday investors. To make sure everything runs fairly and honestly, the Securities and Exchange Commission, known as the SEC, regulates the entire market. Their job is to protect investors, prevent fraud, and ensure markets operate with integrity. So the full ecosystem looks like this. A company issues shares, investors buy them through a broker, those trades happen on an exchange, and the whole system is monitored and enforced by regulators like the SEC. All four pieces work together constantly. Not all stocks are the same. There are two main types. Common stocks give shareholders voting rights and the potential for dividends. Preferred stocks usually don't include voting rights, but they offer priority dividend payments and more stability. Growth stocks are shares of companies expected to grow much faster than average. Think young tech startups or innovative biotech firms. They often don't pay dividends because they reinvest all their profits back into expanding the business. Value stocks are shares of solid, established companies that appear to be priced below their true worth. These are like finding a great product on sale. You buy it because you believe the market has underpriced it and the price will eventually rise.
Income stocks are shares that regularly pay dividends, portions of company profit paid directly to shareholders. Utilities and real estate companies often fall into this category, making them popular with investors who want steady, reliable income. You'll often hear people say, the market is up today, or the market fell 2%, but they're usually referring to a stock market index. An index tracks the performance of a selected group of stocks to give a snapshot of overall market health. Think of an index as a benchmark, a measuring stick. The most famous indexes include the S&P 500, which tracks the 500 largest U.S. companies, the Dow Jones Industrial Average with 30 major firms, and the NASDAQ Composite focused on tech stocks. One of the most powerful features of the stock market is its long-term trend. Despite crashes, recessions, and major global events, the overall market has historically always climbed higher over long periods. Patience is one of the most valuable tools an investor has. When the market is rising over a sustained period, driven by economic growth and investor optimism, we call it a bull market. During bull markets, stock prices climb, confidence is high, and investing feels great. The bull charges forward and upward. When the market is falling, driven by economic downturns, fear, or uncertainty, it's called a bear market. During bear markets, prices drop, investors become cautious, and pessimism spreads. The bear swipes downward, pulling prices lower. Here's the critical insight. Bull and bear markets are both completely normal parts of the investment cycle. Every bear market in history has eventually been followed by a bull market. Long-term investors who stay calm through the downturns typically come out ahead. Why should you care about the stock market? Because investing in stocks is one of the most powerful ways to make your savings grow over time. Instead of money sitting in a bank earning minimal interest, it can potentially compound and multiply. Think of investing like planting a tree. You put in a small seed today, your initial investment, and over years and decades, that seed grows into something much bigger. The earlier you start, the more time your money has to grow. Some stocks pay dividends, regular cash payments made to shareholders from the company's profits. This means your money can generate income even while you sleep. It's like getting paid just for owning a small piece of a business. Getting started investing in the stock market is easier than ever before. Online brokerages let you open an account in minutes with no minimum balance required. You can start investing with just a few dollars and learn as you go. Of course, investing in stocks comes with risk. Stock prices go up and down. You could lose some or even all of your investment in a particular stock. This is why it's crucial to understand risk before you start putting your real money in. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. By spreading your investments across many different companies and industries, if one stock crashes, your other investments can help protect your overall portfolio. A diversified portfolio means some investments might dip while others rise, and the net result over time tends to be more stable and more rewarding than betting everything on a single company. This is the foundation of smart, responsible investing. Ready to start? Here are the basic steps. First, open a brokerage account. This takes about 10 minutes online. Second, fund it with an amount you're comfortable with. Third, research companies or index funds and make your first purchase. Before buying any stock, do your homework. Read the company's annual report, look at its earnings history, and understand what the business actually does. Investing in what you understand is a core principle taught by the world's greatest investors. When you're ready, placing your first buy order is as simple as clicking a button. You decide how many shares to buy, confirm the price, and the order is executed almost instantly. Congratulations, you are now officially a shareholder. And that's the stock market from start to finish. It's a marketplace where companies raise money, investors build wealth, and the global economy connects. You started this video confused, and now you understand how one of the world's most powerful financial systems works. The most important step? Just getting started. If you enjoyed this, please leave a quick thumbs up and let me know your thoughts in the comments. And if you want to go deeper, our next video covers exactly how to choose your first stock, what to look for in a company, and how to build your very first portfolio from scratch. Hit that subscribe button, ring the notification bell, and I'll see you in the next one. Until then, keep learning, keep growing, and remember, every expert was once a complete beginner. You've already started. That makes you ahead of most people. See you next time.